Namaskar to all the viewers across the country. I am Sanjula Haldar, Assistant Director of Income Tax in the Directorate General of Administration and Taxpayer Services, Mayur Bhavan, Delhi. Welcome to another session from Samvad. In this Samvad series, today we bring to you discussion on the topic Pay as you earn. For this episode today, we have with us Srimati Garima Jain, Commissioner of Income Tax, ITA Division, Central Board of Direct Taxes, Department of Revenue, Ministry of Finance. Srimati Garima Jain is an officer of Indian Revenue Service of 1996 batch. She has done her post-graduation in sociology and has a degree in law. She has worked in varied capacities with the Income Tax Department in Gujarat, Delhi, Mumbai, and Lucknow. Presently, as the Commissioner of Income Tax, ITA Division, Central Board of Direct Taxes, she is looking after the policy matters and administrative matters related to the implementation of Income Tax Act 1961. Ma'am, thank you so much for accepting our invitation for this episode of Samvad on the topic Pay as you earn.
Thank you, Sanjula. Namaskar to all the viewers across the country. It is indeed a pleasure and privilege to join Samvad, which provides a platform for positive discourse to share one's understanding of principles and provisions that would be useful for the tax holders and our valued taxpayers.
Ma'am, the pay as you earn concept is prevalent in many tax jurisdictions. It was first introduced for the salaried class to improve the tax base and revenue collection in the country. It was then implemented for the employers who would deduct the tax from the employees before paying them. The pay as you earn concept has been adopted by many tax jurisdictions like Ireland, New Zealand, United States, and Australia in various modified versions. Ma'am, in the earlier session, you had explained the various provisions of advance tax payment, which is a part of the pay as you earn concept. You had also mentioned that there is another variation of the pay as you earn concept, which is called withholding tax or tax deducted at source. There are certain categories where tax is collected at source. Could you please explain what is TDS or TCS?
Yes, Sanjula, definitely. Tax deducted or collected at source, that is TDS or TCS, as the very name implies, aims at collection of revenue from the very source of income. It is an indirect method of collecting tax which combines the concepts of pay as you earn and collect as it is being earned. As discussed earlier, in the case of advance tax, the taxpayer is required to compute the tax liability and pay it. However, under the TDS provisions, the liability is on the person who is making payments of specified nature to the recipient to deduct tax at the appropriate rates from the payments at the time of payment. The person making the payment is the deductor, while the recipient from whose receipt tax is being deducted is the deductee. The deductor is required to deposit the deducted sum to the credit of the central government. The deductee, that is the recipient from whose receipt tax has been deducted at source, gets credit of the amount already deducted and paid on his behalf by the deductor in his personal assessment on the basis of certificate issued by the deductor. Similarly, tax collected at source, that is TCS, is the tax collected by the seller from the buyer of certain specified goods on sale so that it can be deposited with the tax authorities. Section 206C of the Income Tax Act specifies the goods on which the seller has to collect tax from the buyers. However, when these specified goods like timber, tendu leaves, forest produce, alcohol, scrap, certain minerals like coal, lignite, etc., are utilized for the purpose of manufacturing, processing, or producing articles or things, no tax is to be collected at source. It is only when these goods are utilized for trading purposes that tax is collectible. The tax payable by the buyer is collected by the seller at the point of sale. The rate of TCS is different for goods specified under different categories. Tax is collected at the appropriate rates at the time of receipt of the amount from the buyer or at the time of debiting the account of the buyer. The person responsible for collecting tax is required to deposit such sum to the credit of the central government. The buyer on whose behalf tax has been collected at source gets credit of such amount collected and paid on his behalf by the person responsible for collecting the tax in his personal assessment on the basis of certificate issued to him by the person responsible for collecting tax.
Thank you, ma'am. Ma'am, could you please explain the significance of TDS or TCS?
TDS, that is tax deduction at source, it is the most important mode of revenue collection based on the pay as you earn concept. In India, out of the total revenue collection for the financial year 2021-22, approximately 51% of the revenue has come from TDS. The significance of TCS to the government lies in the fact that it prepones the collection of tax even before the advance tax installment date. It ensures a regular source of revenue and provides for a greater reach and wider base for tax. At the same time, to the taxpayer, it distributes the incidence of tax and provides for a simple and convenient mode of payment.
Thank you, ma'am. Ma'am, as we all know that the major part of revenue of TDS comes from TDS on salary. Could you please explain the provisions regarding TDS on salary?
Sanjula, Section 192 of the Income Tax Act provides that every person responsible for paying any income which is chargeable under the head salaries shall deduct income tax on the estimated income of the assessee under the head salaries. The tax is required to be calculated at the average rate of income tax as computed on the basis of rates in force. However, tax is not required to be deducted at source if the estimated salary income does not exceed the maximum amount not chargeable to tax applicable in the case of an individual during the relevant financial year. The tax, once deducted, is required to be deposited in government account within the time limit provided under the Act. Further, the employer or the deductor is required to prepare and file quarterly statements in form number 24Q with the Income Tax Department. At the end of the financial year, a certificate of deduction of tax at source, known as form number 16, is to be generated from the Tracers portal of the Income Tax Department and issued to the employee. Based on the quarterly statements filed by the deductor, tax credits are shown available in Form 26AS to the taxpayer. Based on the Form 16 and 26AS, the employees, that is the taxpayer, can file their income tax returns after claiming the TDS credit. If there is any excess TDS deducted, the taxpayers can claim refund of the same in their income tax returns.
Thank you, ma'am. Ma'am, here it is important to note that with the computerization in Income Tax Department, it has become much simpler for issuance of Form 16, 26AS, filing of quarterly statements. Having said so, ma'am, could you please explain in brief about the applicability of TDS on payments other than salary?
Sanjula, apart from salary payments, it is mandatory for the person making payments to deduct tax at source in respect of various other payments or transactions subject to the threshold as specified in the relevant sections. These payments or transactions include payment of interest, rent, fees for professional or technical services, commission or brokerage, transactions of cash withdrawals above rupees 1 crore, transactions in immovable property, transactions in virtual digital assets, etc. The rate for TDS is higher if the deductee does not furnish PAN to the deductor or has not filed the income tax return during the last assessment year. And the TDS during such assessment year is rupees 50,000 or more.
Thank you, ma'am. It is clear from the discussion that it is mandatory for the deductor to deduct TDS or TCS on specified transactions. However, there can be a situation where a person's income is not chargeable to tax in a particular financial year due to various reasons. But he may be subjected to TDS or TCS. In that year, does he have to file his return to claim TDS or TCS, or is there any other way out?
Yes, Angela. All those who do not have tax liability under the Income Tax Act but are entering into specified transactions which are subjected to TDS can avail the option of lower or nil deduction certificate under Section 197 of the Income Tax Act. Similarly, they can apply for a nil or lower collection certificate under subsection 9 of Section 206C of the Income Tax Act for certain provisions. These applications are considered by the officers and certificates issued in fit cases. Section 197 and Section 206C, subsection 9, enable a taxpayer to make an application to his assessing officer for deduction or collection of tax at a lower rate or for non-deduction of tax. The application has to be made in form number 13 electronically. If the assessing officer is satisfied that the total income of a taxpayer justifies the deduction or collection of income tax at any lower rate or no deduction or collection of income tax, she may issue a certificate in form number 15AA for deduction or collection of tax at a lower rate or no deduction of tax.
Thank you, ma'am. Ma'am, having heard in detail about the TDS provisions, what are the consequences of non-compliance to the TDS or TCS provisions?
Sure, Sanjula. Where the deductor has failed to deduct tax or when short deduction of tax has been done, then deductor may be subject to interest under Section 201(1)(a), 206(c) subsection 7, penalty under Section 221 and penalty under Sections 271(c), penalty under Section 271(ca). I will tell you about these provisions in further detail now. Regarding charging of interest under Section 201(1)(a), under the provisions, the deductor is treated to be assessee in default in respect of the short deduction or non-deduction of tax. Under Section 201(1)(a), he is liable to pay simple interest at the rate of 1% for every month or part of a month on the amount of tax in arrear from the date on which such tax was deductible to the date on which such tax is actually deducted. Further, such interest shall be paid before furnishing the quarterly statement of each quarter. Interest under Section 206(c)(7) is charged in case of default in tax collection at source. The person responsible for collecting tax is treated to be the assessee in default in respect of short collection or non-collection of tax or non-deposition of the collected tax as per the provisions of Section 206(c)(6)(a) of the Income Tax Act. Penalty is also leviable under Section 221. The assessee in default is liable to imposition of penalty where the assessing officer is satisfied that the defaulter has failed to deduct tax as required without good and sufficient reason. The quantum of penalty is not to exceed the amount of tax in arrear. Besides, a reasonable opportunity of being heard is to be given to the assessee. There are provisions for penalty under section 271C. A penalty equivalent to the amount of tax the deductor has failed to deduct is leviable under section 271 capital C. Penalty under this section is leviable only by a joint commissioner of income tax. There are provisions for penalty under section 271 capital CA. In case the specified seller fails to collect the TCS, then for such failure, he would be liable to pay the penalty under section 271 capital CA of the Income Tax Act to the extent of the sum equal to the amount of tax not collected. However, it should be noted that in case the defaulter proves that there was reasonable cause for the failure, no penalty is leviable in terms of provisions of section 273B of the Income Tax Act. There are also provisions of regarding charging of fee for default in furnishing of TDS and TCS statements. A late filing fee of rupees 200 per day is payable in case of failure or delay in furnishing of TDS or TCS statements as per provisions of section 234E of the Income Tax Act.
Thank you, ma'am. Ma'am, as you have mentioned earlier that the persons responsible for deducting or collecting tax have to deposit tax deducted or collected in the government account after deduction. What are the implications, ma'am, if they fail to do so?
Where the employer has deducted the tax at source but failed to deposit, wholly or partly, the tax so deducted in the government account, the following statutory provisions are attracted. Interest under section 201(1)(a) is chargeable. The deductor is treated as an assessee in default, and interest under section 201(1)(a) is leviable at the rate of 1.5% for every month or part of the month on the amount of such tax from the date on which such tax was deducted to the date on which such tax is actually paid. Further, the tax along with the simple interest under section 201(1)(a) becomes a charge upon all the assets of the deductor. There are provisions for penalty under section 221. Penalty to the extent of tax not deposited is leviable by the assessing officer, as we discussed a little while back. Prosecution proceedings under section 276 capital B can be initiated where the deductor has failed to deposit tax deducted at source in government account without a reasonable cause. Then he is punishable with rigorous imprisonment for a term which shall not be less than 3 months, but which may extend to 7 years, and with fine. There are provisions for prosecution under section 276 BB. If the person fails to pay to the credit of the central government the tax collected by him as required under the provisions of section 206C, he shall be punishable with rigorous imprisonment for a term which shall not be less than 3 months, but which may extend to 7 years, and with fine.
Thank you, ma'am. Ma'am, what are the consequences when there is a failure to apply TAN or quote TAN?
TAN is the tax deduction account number that is to be obtained by all persons responsible for deducting tax at source. Where a person who is responsible to deduct tax at source has failed without reasonable cause to apply for TAN within the prescribed period or after allotment, fails to quote such TAN in challans for payment of tax or TDS certificate or returns of TDS, then a penalty under section 272 BB of a sum of rupees 10,000 is imposable by the assessing officer. However, a reasonable opportunity of hearing must be given to the deductor.
Thank you, ma'am. Ma'am, what happens when there is a failure to furnish TDS statement or TDS certificate Is there any penalty also which is imposed on such failure?
Where the deductor has failed to issue TDS certificate or has failed to furnish the quarterly statement of tax within the time prescribed, a penalty under section 272A subsection 2 of rupees 500 is leviable for each day during the period for which default continues. It is relevant to mention that the quantum of penalty has increased from rupees 100 to rupees 500 for each day by the Finance Act 2022 with effect from 1/4/2022. The quantum of penalty is not to exceed the tax deductible, and the penalty is to be levied only by a joint commissioner or joint director of income tax after giving the assessee an opportunity of being heard.
Thank you, ma'am. Ma'am, going further, could you please explain the prosecution provisions under section 277?
As per the prosecution provisions under section 277, where a person who is required to furnish statement under section 200 subsection 3, the quarterly statements, makes a false statement in verification or delivers an account or statement which is false and which the person knows or believes to be false or does not believe to be true, then he is punishable with rigorous imprisonment for a term which shall not be less than 6 months, but which may extend to 7 years along with fine. Where the amount of tax which would have been evaded if the statement or account had been accepted as true is rupees 25 lakhs or less, then rigorous imprisonment may be from 3 months to 2 years and with fine. Thus, Sanjula, the tax deductors and collectors need to be well conversant with the provisions relating to tax deduction and tax collection at source as provided in the Income Tax Act.
Thank you, ma'am, for patiently explaining all the provisions related to the concept of pay as you earn with a focus on TDS and TCS. The philosophy of pay as you earn is deeply entrenched into how the Central Board of Direct Taxes administers direct taxes. It is also crucial for garnering of resources for the government. In today's session, we came to know about the pay as you earn concept with a focus on TDS and TCS. With this, we come to the end of today's session. Thank you all for joining in for this episode. Do follow us on our social media handles on Facebook, Twitter, LinkedIn, YouTube, and Instagram for more updates and informative content. Until then, from Samvad, thank you and Jai Hind.